everyone. Uh, big, big thanks to everyone for joining us today. And on behalf of the Real Estate Board of Greater Vancouver, I'd like to thank you for joining us today for our mortgage session webinar. My name is Jason Plank, and I'm one of the regional managers for the mortgage specialist business with RBC in the Lower Mainland, and I'll be your moderator for today. Today's event will begin with a presentation followed by a Q&A. You can type your questions into the Q&A section found in the panel at the bottom of your screen. We are recording the session and it will be available online in the coming days. Now, with great pleasure, let me introduce our speakers for today. We have Mabel Coe. Mabel is a mobile mortgage specialist with RBC. She's been in this role for over 11 years. And Mabel's previous experience as a commercial account manager with RBC has allowed her additional expertise in working with healthcare professionals and self-employed. Our other speaker is Kenny Wynn. Kenny is a senior mortgage specialist with RBC in his role for 22 years. Kenny has combined his passion for the outdoors and community by volunteering with Vancouver Adaptive Snow Sports. So please join me in welcoming Mabel and Kenny. Now,
thank you, Jason.
Thanks, Kenny. Mabel, so we'll just advance to our agenda. And so Kenny, if you're able just to advance the slide of the agenda today, we're just going to provide some discussion around interest rates. It's obviously a hot topic and something that we talk about quite a bit on our own. Advice that a lot of lenders are providing their clients and their realtors in their business network, and then also just around alternative mortgage solutions. And we chose alternative mortgage solutions because with the high cost of housing that's still out there and the cash flow with the high interest rates, we are finding that AMS, alternative mortgage solutions, is becoming a much bigger option for a lot of potential borrowers in the Lower Mainland. I'll kick us off with an update from RBC Economics. Just a quick disclaimer. I'm a banker. I'm not an economist. Our economists are experts in economic matters like inflation and interest rates. But I am able to read what they put out, and I can pass on their results to you. And it's something that I'd say over the last year and a half, I'd really be paying a lot of attention to what they're writing, just given the current economic environment. So there's really three primary factors that are driving interest rates right now, and that's employment, GDP, and inflation. And those three items also greatly impact each other. So you can get sort of a cyclical effect from those three factors. So just a quick note on employment. July was a very interesting month. It's in the can now. And we actually saw a 6,000 job decrease in Canada in July. I think some of you may recall in late winter, we were still seeing jobs added at a rate in the hundreds of thousands. And even as recently as June, I believe we had 60,000 new jobs. July was the first month where we started to see a bit of a decline in terms of the number of jobs. So we actually lost jobs. And what this resulted in was an increase in the unemployment rate. And so the July unemployment rate between April and July rose to 5.5%. That's a full 0.5% increase over a 3 to 4 month span. So it's pretty significant. The flip side to that, though, and I say flip side because I'm giving you some news that on the surface probably seems kind of bad, kind of negative. Nobody wants to see the unemployment rate go up. Nobody wants to see people, their neighbors, our clients potentially lose their jobs. And that is in general bad news. But it really is an area that the Bank of Canada is focusing on right now, which is unemployment. They've said a few times that that in order to get us to a point where inflation reduces and they're able to actually reduce the overnight lending rate, we do need to see less people in the Canadian economy working. So again, that's a bad news story, but again, the good news is that it can result in something quite positive with interest rates potentially decreasing. Now, so with wage growth, quick comment about that is it is up 5% year over year, and recently we saw a 0.9% increase from June to July. That's pretty significant. And why we're seeing that is there's a lot of labor groups whose contracts are coming due. something that's quite topical, as we've just seen the BC port strike resolved. And really, it's quite simple. As inflation increases, that basket of goods that we need to buy to keep our households and our families satisfied, our households running, it's gone up. And so the amount of income that a person earned 2, 3, 4, 5 years ago isn't quite sufficient to pay for that same bundle of goods. And so we're seeing a lot of labor groups going in and renegotiate contracts at a much higher percentage wage increase than they would during a stable inflation environment. So it's kind of a bad news part. So the bad news is that wages are up. Now, again, good news, bad news. I'm sure the person who got the increase in wages is super happy, but it does have a bit of a drag or negative impact when it comes to inflation and interest rates. I'm going to jump to GDP, and so gross domestic product. It's a measure of a country's total output, which is really just a fancy way of saying that it's the total of all the spending in a country's economy by its government, the businesses, and its consumers, its residents. So it's an aggregate of everything, and that's both on goods and services. And so this is a really big number. It's a number that has proven to be quite steadfast coming out of the pandemic. And so some recent figures, May's GDP numbers increased by 0.3% over April, which is pretty frothy. But the estimate for June, which isn't out yet, is that GDP is actually going to come in at a negative 0.2. So combine the two, a 0.1% growth hopefully is quite low. The estimate right now, the trend right now, again, there's a bit of lag in GDP numbers. We won't see those probably till the end of August, maybe early September. But the estimate right now for Q2 GDP growth is 1%. 1%. It's been trending much higher than that, again, during the pandemic and in 2022. 1% is pretty significant. Why is this important? The Bank of Canada's forecast for Q2 was 1.5%. So if the actual GDP comes in lower than what the BFC forecast, again, that's a positive number for them to potentially either pause interest rate increases and hopefully sometime in the not so distant future actually reduce interest rates. So a little bit more on GDP and spending. Canadian spending, we actually do have the July numbers. Canadian spending did show signs of slowing in July. Retail sales still continue to rise, but at a much slower pace than in June. And if you remove autos, which is a very expensive portion of a person's budget, auto sales are actually showing a bit of a decline. And so Canadians are choosing to spend less and less on new and used cars. There was a bit of a flurry because I think there was a backlog in product to choose from, but they are actually making better choices to keep their existing vehicle for a little bit longer. Spending on discretionary services slipped a bit in July. The early summer travel boom that we were all being warned about when school was getting close to closing for 2023, it is losing momentum. And in fact, the peak that we're seeing right now for travel was actually in March. That's when Canadians were spending the most money on travel. And so we're actually seeing less money being spent on travel as of July. That's positive. Restaurant spending. So again, this has been something that's increased quite a bit over the last year and a half. Again, with restaurants reopening, people feeling safe and going to restaurants more often. They've been opening up their pocketbooks and spending more. But what we're actually seeing is that restaurant spending, even though it's still continuing to increase, it's not because of additional visits. It's actually because restaurants are having to spend more money on labor and food. They're passing those costs on to their customers, and we're seeing a larger ticket at restaurants. So again, good news here, if you will, is that Canadians have slowed down the number of visits. They're not going more. They are still going out, but they're spending a little bit more on that meal than they once did. And I'm sure a lot of this is probably ringing true into a lot of the individuals that are on the call today. It probably is ringing true to your own households as well. So spending remains firm. There is early signs of softening, and it is consistent with a drift that's higher in the unemployment rate. And as we progress in the second half of the year, the estimate is that real consumption is expected to retreat as household debt servicing ratios climb to record highs. So again, I'm just trying to interpret what this means. Household debt servicing ratios. It just means that people are allocating more of their income, their discretionary income, to making debt payments. And it doesn't necessarily mean that people have more debt. They might, but they definitely are having to allocate more money onto the interest portion of those debt servicing costs. So our best estimate right now is that about 1/3 of all Canadians have felt the pinch of higher interest costs on their mortgages. And that may mean that they were in a variable mortgage product, or that they were in a fixed rate mortgage product that has renewed in the last 18 months, and it's renewed into a higher interest rate. So that 1/3 of Canadians right now is feeling a bit of a pinch in the pocketbook with higher debt. But if this makes any kind of sense at all, it's not something we can measure in days or weeks. It's probably something we've got to measure in months. So on a quarter-to-quarter basis, more and more Canadians' mortgages are going to renew, and they will be renewing into higher rates. All right, so where does this leave us? I'll just talk a little bit about inflation, and we'll jump into interest rates here. June inflation finally fell into the Bank of Canada's target range at 2.8%. So that's good news. Their target range is 1 to 3, but the Bank of Canada has been very firm, and they are telling Canadians that they will not take their foot off the gas pedal until it hits 2%, that 1 to 2% range. And again, that's just general CPI inflation. The Bank of Canada has its own core inflation that it's monitoring, and that core inflation is still sticky at 4%. So even though we're getting headline inflation at 2.8, that core item that they're measuring is at 4%. So again, they want to get that 4% down to 2. The good news is it's happening. It's just happening very, very slowly. So a quick note on interest rates. Again, just a bit of a forecast. It is believed that as more and more Canadians' mortgages start to renew, the worst, I'll say the worst, that's kind of a negative word, but the worst is yet to come for consumers. And so there's this lag effect of the rapid rate increases that we saw in 2022. Again, as more consumers' mortgages start to mature, they're going to be spending less and less on consumer goods and services. Again, the expectation is that spending will soften. It's going to push inflation lower, which will push the Bank of Canada and many other central banks onto the sidelines for the remainder of 2023. That's our prediction. Unemployment rates are increasing. Expectation is GDP will continue to decline, and probably in the back half of 2024, so Q3, we may actually start to see a reduction in the Bank of Canada's overnight rate, which obviously impacts the variable rates that the banks are offering clients. So again, that's 2023. That may seem like a long way out because in my mind, it's at least 10 months away. But if there's an expectation from analysts and investors that this rate decrease is coming from the Bank of Canada, we actually will start to see a softening in the more longer term rates. So rates of 3, 4, 5 years, hopefully in advance of Q3 2024. So again, a little bit of an update for you in terms of economics. I'm going to turn it over to my colleague, Kenny, who will chat a little bit about the advice that we're giving our clients right now.
Thank you, Jason. So as Jason mentioned earlier, he was talking about the economics of Canada and the impact of what it has on our business, meaning yours and mine. As a lender, how does this economic changes impact what we do? And also how does it change, all these changes impact what you do? So from an advice perspective, when we look at the impact of higher interest rate in this environment, how does it impact our buyers? And this is where it's really, really important to have these conversations with our clients on a regular basis. So for example, if we were to look at a few years back, our government introduced stress test. And in that stress test, we have to add 2% on top of the client's contracted interest rate. So for example, in today's market, we're looking at a rate of 6% on a 5-year term. That's just one example. But when we qualify our client, we have to add 2% on that contracted rate. So now that rate becomes 8%. It's not what we charge our client, but it's what we have to use to qualify the client. If we go back 3 years ago, when interest rate was what, 2.5%, 3%, when you add 2%, it's not that bad. But when now we're adding on a 2% on a 6%, the payment has changed dramatically. And therefore, our buyers are not able to qualify as much as before, nor can they want to afford to make the payments based on today's interest rates. So as an example, in our Burnaby market, a two-bedroom condo is probably ranging around $800,000. Let's assume their mortgage is about $600,000. When we look at previously, when rates were 3% versus today's interest rate of 6%, it's a 3% gap. That means it costs them about $18,000 a year extra for that mortgage. Therefore, their payment has increased by the same amount per month. So when we look at 18,000, that's a lot of money. Divided by 12, that's a lot of money that they have to get used to, right? So the question now with our buyers, do they want to get into the real estate market, buy at today's interest rate environment, or are they going to be very cautious? And right now we're seeing a lot of clients who are very cautious as to, do they want to get into the real estate market? Can they afford to do it? So we're at the position where we have to look at two different things. The client's affordability, can they qualify? How much can they qualify? And this is where a lot of the conversation is being had. So as realtors, if you are working with your buyers that were, that you took on, let's say 6 months ago, they were qualified for a certain amount of money in terms of mortgages, but then now with interest rates increasing, are they still qualified for the same amount? Are we still taking our clients out shopping for real estate based on 6 months old data that they're working with? Or have we had the conversation with them and asked them, have they visited their bank recently, and have the conversation around have the new interest rate impact them, right? So that's what's happening with interest rate and how it's impacting our business in the sense of, are our clients still qualified and can they still afford the new payments with today's interest rates? So to take it back a little bit further, closer to time-wise, today's interest rate again is 6%, for example. But when we look at March or April, we're below 5%. Those rates alone on a $600,000 mortgage, you're still looking at $500 difference in mortgage payments. How much is that impacting our day-to-day clients, right? Some clients may not be impacted at all, but the majority of our clients will be impacted by a $500 increase for sure. So now let's look at the other side of the spectrum in terms of our sellers. How is this impacting our sellers? Well, clearly the impact is the same because the buyers that were able to purchase these properties may not want to because of the new payments, nor do they want to be paying, nor can they afford to buy it, or can they qualify to buy. So that's where we have to visit with our sellers to see if they're still in the same position with regards to the price that they're listing their property for. Now, if we add on another layer to this, what if your seller is also a buyer? They're selling their home and now they're looking to buy a new home. They're sitting on a mortgage, for example, $300,000 that they got years ago. They're paid it down, now it's at $300,000. In their mind, if I'm paying a mortgage at $300,000, why would I have a problem getting approved? This we hear day in and day out, and I'm sure you probably talk to your clients and they think the same way. But when they got their mortgage, the qualifying stress test was a lot lower than what it is today. So prior to helping our clients with their sale of their home, are they looking to buy? This is where we have to educate them as well. Have you been pre-qualified? Can you still afford to move, right? All this other stuff has to be discussed to help our sellers be in a position where they can sell and purchase without having any hiccups along the way if they're not able to qualify due to the higher interest rate environment that we're in. So those are the main impacts that we see on a day-to-day basis with our buyers and our sellers when it comes to the higher interest rate environment that we're in. How about our past clients? Jason has mentioned earlier that a whole bunch of our clients are coming out of renewals very soon. So let's look back 3-4 years ago during COVID when rates were practically free. Some of them are coming up for maturity next year. Some of them maybe 2 years from now. At the rates that we are today, will our rates come down to the much lower interest rate that they've experienced during COVID? Most likely not. Most of these clients were qualified at a much lower interest rate. they were paying mortgage payments at a much lower value. Now they're maturing into a higher interest rate environment. Are they prepared for the new payments? As lenders, we call our clients prior to maturity to have this discussion with them. But as real estate professionals, have you thought of doing the same thing with your clients? Right? Because it's just an added value that you can help your clients, because we hear about high interest rates all day long, but have any one of our clients really thought about how it will impact them if their mortgage matured today? They're coming out of a 2% interest rate to a 6% interest rate. How would that finance impact their family household? And I think this is where we as professionals can have this discussion with our clients as lenders and our clients as previous buyers and sellers, right? And this is really important. If we can take that time to have this conversation, then we add value to what we do every single day. So this is my part of the impact. And Mabel is going to actually talk about the fun stuff, all the other stuff that we do on a day-to-day basis. So let's, Mabel, you're next.
Thank you, Kenny. Thank you, Kenny. Yes. So yes, as Kenny said, we're going to talk about the fun stuff. I'm going to share with you some essential advices that we give to clients and realtors in today's challenging interest rate environment. First off, we advise clients to look beyond their immediate mortgage needs and look at the whole financial picture. What that means is, for example, a first-time home buyer seeking for a mortgage may not realize how valuable it is to speak to a financial advisor at early stage when they're saving for down payment, so that they can get proper advice on how to better invest their savings, choose efficient savings plans like RSP, first home savings accounts, or tax-free savings accounts. That's just some examples. Now, as mortgage specialists at a full-service bank, we have access to financial advisors, investment specialists, whom we often bring to our client meetings, where we would help the clients to better position themselves to reach the home buying goals. Yeah. So another thing we want to share with you is, you probably all know it very well, which is the value of pre-approvals. I know Kenny already touched on the advice to buyers and sellers, but we can't stress enough how important this is. And we know how hard you work to get to the stage of having an accepted offer for your buyers. And the last thing you want to hear is that your buyers cannot get the financing. So having a pre-approval done ahead of time would reduce your chance of disappointment for you and your clients. So what I would also like to stress, in this rising interest rate environment, which translates to higher stress test rate, it is very important to get a pre-approval if your clients are thinking of switching properties, which is selling and buying. Because if they sell first, they don't have a pre-approval to buy the home that they want to buy, they may not be qualified, because what they thought they were qualified for before may not look the same at all. The picture has completely changed. So it is important, especially for clients who are switching properties, to get a pre-approval. Now, the next thing I want to talk about is along this line, mortgage portability. Let me first explain what mortgage portability means. Mortgage portability is a feature that lenders provide, some lenders provide, that allows a client to port their existing mortgage on the property they are selling to the property that they are buying. And for some lenders, they also allow them to port to one of the existing properties. So that's essentially that's what it is. Now, what this is very essential because what we recommend that you advise all your clients who are selling before they sell, go talk to the lenders and ask them two questions. One is their mortgage portable? Second, do they qualify for a mortgage to purchase the home that they want? Now, if the answer is yes to those questions, then it could be very good news for your client, because that means they can keep their existing interest rate and move it over to the new property. And in today's high interest environment, that could mean a lot of interest cost savings. And to top it up, this could also mean they could potentially eliminate or reduce their prepayment penalty. So that's a lot of cost savings for your client. So we would definitely recommend you talk to your client to do that. The next thing, pre-sale contracts. I get actually very excited when I talk about pre-sale contracts. Let me ask you, how many of you have had an experience where your pre-sale clients call you in a panic mode when they receive the notice of completion from the developer and they are telling you they can't get the financing that they thought they have, or they just can't get it because right now the job situation has changed, or they took out a loan without realizing it would affect it, or the appraised value came back not as satisfactory. Now, if you have experienced it and you want to avoid it, I would recommend you to talk to RBC, can get a firm approval. Now, when I say firm approval, at RBC, we offer firm approvals for pre-sales. Doesn't matter they're closing in a year, in 3 years, or 5 years. If we can get them a firm approval today, we stand by our firm approval and we fund no matter what at completion for the client. So it takes away a lot of risk and uncertainty for the client and for you. Now, how that works is we adjudicate the file upfront. So we ask for income documentations. We ask for the asset situation, the down payment situation. We do credit check upfront. We also do appraisals upfront. So once we get to a stage where we give them a firm approval, we do not do an additional review before completion. So our firm approval is not like an approval subject to income documentation or subject to appraisal, none of that. And we don't pull credit check again. So that means if you have a firm approval, you will get your mortgage to complete your purchase. So I strongly advise you to ask your client to consider that. And I just also want to share with you, during the COVID pandemic, we have had a number of clients who have bought a pre-sale contract and have lost their jobs. And they were very worried they were unable to close the deal. But when they when they come to us and we explain to them how our firm approval is going to help them complete the purchase, it was such a relief for them. And they were so thankful to not only to us, also to the realtors who advised them to come to us to get the firm approval. So this is something that we really recommend you do. Let's see, the next thing. Yes. So besides these few topics that we picked on to share with you on the advices, we also want to let you know there are a lot of programs that we choose and pick to help fit your clients' needs, to help them qualify. So in front of you is a list of programs that lenders have. And due to time constraint, I know I can only do a quick one-liner to give an overview of what this program is. And then, and I know a lot of you might already have a scenario in your mind. You may have a few clients scenario in your mind and wondering, okay, so would any of these help my clients? And we're happy to go into more details offline. So feel free to reach out to Kenny and I. But right now, I'm just going to give you a quick overview with the one-liner, and then we'll move on due to time constraint. Okay. So newcomer to Canada. Essentially, this allows us to help newcomer who haven't established an income level that's the same as what they were earning before, to get approvals. So we're based on their historic employment income to help them get to purchase a home here. So that's just there are many other mini programs within newcomer. So there are more we can talk about. Self-employed stated income. Self-employed stated income is basically we can state an income higher than what the self-employed individuals declared in their personal income tax return, and that we can do that based on the strength of the business cash flow. So that's something that we can help a lot of self-employed clients to buy properties. Foreign income. Foreign income, we can use income earned outside of Canada to qualify for mortgage here. And now this has become actually quite popular because many Canadian residents living abroad are seeing, real estate prices have gone up so high. They want to get in now, buy the property, and so when they eventually return home, they have a property to live in. We can help them in that scenario. And then move on to investor. Investor basically is will help clients to buy investment property. And one key thing I can point out is that we can use the market rent of the property that they're buying to offset the property expenses, and then we calculate the ratio that way. So we're able to boost up the income we can use, basically. Wealth accumulator. Wealth accumulator. Sorry, yes.
Sorry to interrupt you. The other great thing about the investor program that we have is that lately we're able to include 75% of the down payment coming from gifted sources. Whereas before it had to be their own sources. Now we can actually use 75% of the total down payment coming from a gifted source. Sorry, I just want to point that out because that's very unique to us.
Yes, that is very important, and it has enabled us to help a lot of clients to get into the investment property market, especially for young people, because they have saved up. They may not have the chance to save up as much down payment, and their parents may be able to help them with 75%. As long as they have saved up 25%, it's good to go. The qualification for down payment is fulfilled. Thank you so much, Kenny. Yes. Okay. So for wealth accumulator, we basically allow this allows us to use the strength of clients' accumulated liquid assets to get qualified, and we focus less on the income requirement. So we can do quite a bit for clients, even if they have very minimal income, even if they're retired, as long as they have a good size liquid assets. I will not go into details, but we can maybe just talk about it after if you have more questions on that, because there are also sub-programs under that. Now, with healthcare professionals, this program allows us to use projected income for medical and dental residents and new medical doctors and new dentists within 3 years of graduation. Now, medical dentists, medical residents, and sometimes dentists do residents. For them, their income is a lot less. It's usually in the 60 to 80,000 range, but we can use like a 6-digit number we can use up to 225,000 as projected income for them. And for specialty medical residents and medical doctors, we can use up to 300,000. So we can do a lot for them. So yes. So for construction, so this allows us to finance both the cost of land and cost of construction to help clients build their home. Second last, residential mortgages under personal holding company. I know a lot of clients, investors, were under the advice of accountant to purchase the property in their holding company. So we strongly advise you to come talk to us early, because for eligible holding companies, certain eligible structure holding companies, we are able to allow residential mortgages and home line plan as well to be granted to in name of a holding company. So that could translate to huge interest savings costs, because that means you can use regular residential mortgage rates rather than you have to go to to get a commercial loan for that mortgage. So that's the advantage of that. Leasehold, last but not least, leasehold lending on First Nation land. So this program allows us to help clients to purchase leasehold property on First Nations land. A quick note on this type of transaction: the maximum amortization must be at least 5 years less than the lease expiry date. So depending on the client's ability and how much payment they can afford, this could be a factor. Now also, and yes, and so if none of these programs work, we still have a well-kept secret, which Jason has mentioned at the beginning, which is our alternate mortgage solutions, which Kenny is gonna go into with details for us. Here you go.
Thank you. So alternate mortgage solutions, or what we call AMS here in the bank world, because we like to shorten everything when we talk to each other on our side of the business, is an alternative for our clients, really. So let's say, for example, when we go back to Mabel's list of programs that we have for our clients, some may not fall under this program for whatever reason. They have poor credit, whatever the case may be, they may not fall under these programs that we have for our clients. We actually work with our alternate mortgage solutions individuals. These are employees of our organization that actually help us finance real estate for our clients where traditional banking criteria don't fit with them. So for example, if our client is high debt ratio, when we talk about interest rates being so high, they can't qualify because the debt ratio is way out of whack, and there's no program that will fit this category because, for example, if there's self-stated income, the self-stated income doesn't really fit with what we need the income to be to qualify them, then we have to use an alternative. So alternate mortgage solutions will find a source of funds for our clients to help ensure that our client can complete on the purchase. This actually was used quite a bit during the whole COVID thing with clients who have bought pre-sales that did not get their firm approval up front. We use alternate mortgage solutions to temporarily tide them over. The idea of alternate mortgage solution is to put a mortgage on the property your clients purchased with a very short term. And that short term allows us as lenders to go back again and start trying to fix what we need to fix. For example, if our client has bad credit, what do we do to fix their bad credit? Is there a collection? What do we need to do to remove that collection so that we eventually move that mortgage back to the A lender? So for example, again, like I said earlier, if our client has overextended themselves and now they have to complete on a purchase, or if your client have removed their subjects thinking that they're already approved because they have sold their house with a $300,000 mortgage and now are moving to a new home and needing a $300,000 mortgage, but they don't qualify because in the time of owning that home ownership, they forgot to pay their taxes and now there's a lien against their property and all that stuff. It's creating them to be not able to qualify at a traditional bank. So we move them over to alternate mortgage solutions so that we get the financing in place. They're not in breach of contract. You can complete on the purchase with your client and have them come back to us in a very short time. Usually we put them into a 1-year term or something that's open if it's fixed, or if your client, for example, did not pay their taxes, and now they need to come up with the funds to pay their taxes so that now we can move them back to the traditional bank. All these reasons, when we cannot finance our clients, we bring in our alternate mortgage solutions team, or sometimes because we know ahead of time, we may bring them in while we're working on this file because we want them to find a source first as well, and we can still work the file. And sometimes, Mabel can attest to this, is that we send them to alternate mortgage solutions, get the funding there, but now we still have a week before completion. We still do our darnest on our side, and sometimes we save them by keeping them at the local bank. So we utilize this service that we have within our organization to make sure that we remove the extra stress that's not needed. Remove the subjects or remove the finance and whatever we need to do to ensure our client gets the funding they need. So that's our secret that we wish is not a secret, but for some reason, it always stays as a secret. So there's 300 of you on there. Please tell your friends that there is this option for your clients, whether, with any lender, there's this option. Okay.
Excellent. Well, thanks, Kenny. Thanks, Mabel.
You're on mute.
Just want to make sure everybody can hear me.
Sorry, you can stay off mute.
So just want to say a big thanks to Kenny and Mabel for walking us through the bulk of the presentation. I'll just leave the disclaimer up. I'm not going to read this, but one thing I wanted to mention too, if you really are keen on just trying to get economic data, and it really doesn't matter what your source is. I know there's a number of different ways that you can stay on top of what's happening both in Canada and globally. But if you did notice on the economic slide that was one of our first slides in the presentation, there actually is a website that you can go to if you want to subscribe to information. It'll hit your inbox when you hit the subscribe button. I'm getting at least 2 or 3 updates right now per week from RBC Economics, and they're just quick little hits, bullet points, 4 or 5 interesting bits that tell us a little bit about current StatsCan releases and where they think the direction of different measures or metrics are going to go. And then the other one is a podcast, and again, we've got a Take 10 podcast that is produced by 2 of our senior economists. And again, if you're making dinner, walking the dog, and you like to listen to podcasts, that might be a great way just to stay up to date in terms of what's happening out there. So again, I'll just bring back to that slide. The other item here, again, we'll just advance to the next slide here, Kenny, if we can. And I'm just bringing up both Kenny and Mabel's images. I know you've seen them on the screen, but we've got their contact information here as well. If there's anything that sounded interesting or intriguing to you, you want to run any specific scenarios by them, I would definitely encourage you to reach out to them. They are more than capable to help you out and your clients out. And then the other part here too, I know we did mention RBC a bit. You've obviously got the logo in the slide here. A lot of what we talked about today, again, like if you've got a favorite lender, whoever that favorite lender is, a lot of what we've talked about today applies to whatever that favorite lender can offer. So Kenny did mention AMS. We mentioned it from our lens because that's what we're exposed to daily. But there certainly are another number of charter banks and A lenders out there that do offer a similar service. So again, I would really encourage you to look into it with whoever your favorite lender is. And on that note, again, I'll just say a big thanks once more to Mabel and Kenny. And we will now open up our Q&A period, and we'll try to get as many questions as we can in the time allotted. We've got a few, and okay, we'll just move it forward one more slide. So there's some challenging ones here, and I might have to rely on Kenny to be able to help me out. I'll tackle what may be the most challenging, but also I think also on a lot of people's minds right now. I'll read this in full. If the trigger rate is hit for a client's mortgage, and so let's say that happens in year 1 of 5 on a variable, and even prepaying the mortgage won't make the payments cover monthly interest. Can the bank force customers to reapply and go on a fixed rate instead of a variable? What if the clients just want to extend the amortization? Do banks typically allow for monthly payments lower than the interest payable for a while until rates go down? Or will this situation force clients to sell if they can't get reapproved? So again, I'll tackle this. And again, Mabel and Kenny have probably had this question come up quite a bit from some of their clients. From what I know of the Canadian banks, they subscribe to different ways to treat the trigger rate. And so at RBC, if the trigger rate is hit on a variable mortgage, and I'll just to be very clear here, anybody who took a variable rate mortgage between March of 2020 and March of 2022, you hit your trigger rate last year. You hit it last fall, and that's a lot of people, right? That's more than 50%. I think the numbers last time I checked was that 75% of Canadians that are in a variable rate mortgage had already hit their trigger rate, and so that's a lot. So again, the way Royal Bank treats a trigger rate is we always want to make sure that our clients are at least covering the minimum interest payment that's associated with that mortgage. And so that minimum can and will adjust whenever there's an increase in the variable rate. And so that variable rate mortgage payment can actually will increase on whatever your repayment schedule is. Now, the challenge with that is that the amount that goes to principal, the amount that was originally agreed upon with that lender, is going to get less and less. It's going to get squeezed out. So you know, instead of like hundreds of dollars going towards principal repayment, it's dollars. It's dollars and cents. And so now not every bank runs that way. There are some banks that will maintain the same payment, even though the variable rate has gone up. Is that good? Is that bad? It's hard to say. The challenge with that, though, is that if you're maintaining the same payment that you negotiated with your lender and the rates tripled, right, then all those interest costs that you should be paying are actually now added on to the principal balance. So your principal balance that maybe started at $300,000 can grow to $305,000, $310,000, $315,000 because the interest costs are all added onto it. So again, great that your payment hasn't changed. You're good, you're safe, your cash flow is protected. But at some point in time, that mortgage is going to come due for renewal. And at renewal, who knows what the interest rates are going to be, because those mortgage payments weren't, the interest rates weren't covered head on. Your payments are going to be considerably higher if there's no rate change at renewal. And this goes back to, sorry, I want to try and answer this, but even at RBC, if you're not tackling that principal portion at renewal, you are going to be looking at a substantially higher payment. Now, there's another point here too about what if clients want to extend the amortization. So we're just getting a beeping sound. Apologies for that.
I don't know what that is.
We're not too sure where that's coming from. Can we force customers to reapply and go on a fixed rate? So no, I don't think we can force customers to reapply, but at renewal, they may have to, they will be asked to go back into standard repayment, and that might be higher than their actual cash flow, and they may want to explore other mortgage term options. All right.
Hey, Mabel, are you hearing that noise?
The tick sound?
Yeah, there's a beeping sound coming from somewhere. Sorry, we'll just ignore it. No, it's not my watch.
All right. Okay. So the next question here is, And hopefully I've answered that here, but when RBC does a firm approval, what kind of interest rate will be given? Is it based on current interest rates? Kenny, did you want to tackle that one?
Sorry, what was that? I'm trying to figure out what this was.
I know. Sorry, we're caught off guard with this beeping sound. I apologize. When RBC does a firm approval, so this would be on a pre-sale,
Yep.
what kind of interest rate will be given? And is it based on current interest rate or future rates?
That's a great question. The answer to that question is no. It's not going to be today's interest rate, because what we're doing is we're hedging the interest rate in the future, right? So the bank is taking on a risk that rates are going to go higher, lower, whatever the case may be. So our rate is going to be higher than today's current interest rate. And how high really depends on the term that we choose in terms of holding the rate. So if we hold the rate for 6 months, it's not going to be much different than today's current interest rate. But if we're expected to hold the rate for 5 years, it will be a very different interest rate. But here's the great thing. At completion, we can actually convert that rate approval into the current market rate. It's called resetting the rate into the retail price. So the idea with the firm approval with the pre-sale, it's not really around the interest rate, right? It is around the interest rate when the interest rate is going up, because we want to protect our client with the interest rates. But if the rates are going down, our client is going to get the lower interest rate anyways at completion. But what we want to avoid is that if something happens to our client medically, they cannot work, their credit bureau, something happens, they cannot get the financing, or they lost their job, whatever the case may be that prevents them from getting a mortgage upon completion, that's what we're avoiding. That's the idea around our firm approval for pre-sale. But here's the other great thing, the other secret that we have. These pre-sales, when we do a firm approval, we can actually put what's called home protector insurance on it that the client does not pay. So it's life and disability insurance that your client does not pay until at completion if they choose to keep it. But during the time of construction, the insurance is in place. So if, for example, they go skiing and something happens and they can no longer work, the insurance will kick in at completion. All this stuff is free to your client during the construction period. So it is very important to talk to your client about the pre-sale purchases. The other thing, like Mabel mentioned earlier, is that the appraisal is done up front. So regardless of what's going on with the current real estate market, what if you bought at $1 million and now it's only worth 800,000? It doesn't matter because it's a firm approval up front. But it doesn't mean if your client bought it for 800, now it's worth $1 million, they want to borrow up to $1 million. We don't do that either, right? So we just have to make sure that our client is firmly approved based on the amount of down payment they're going to put down, get their mortgage secured. That way, if something happens and they cannot qualify at the end, they will be qualified and they will move forward with the purchase. And that's the key thing around our pre-sale firm approval. But going back to your question, no, the rate is not today's interest rate. I wish it was, but I can guarantee you 2 years ago when we were doing this on pre-sales and rates were at 2% and we're telling our client it's 3.5%, they're like, oh God, Kenny, it's so bloody expensive. No, we're not gonna do it. I'm like, take it. The ones that did, they're completing on purchases that are completing now at 3.5%. They are laughing. Like that's probably the best thing they ever did. And and it's because of clients like realtors like yourself telling them about what we offer here at the bank, right? And when our clients are doing this, there is no, we're not gonna do it. We actually make them do it. Sort of, not that way, but we do encourage them to do it. We make them do it.
So in essence, we can interest rate proof a buyer's purchase. They've got the option to go with that long-term interest rate, which will be higher than current rates, I guarantee you. Or when it closes, they have the option to.
Oh, sorry, cannot hear you. Jason, we can't hear your voice.
Mabel, you hearing me?
Yeah, I
Can you
hear
hear me
Kenny
okay?
now. Oh, I can hear you now, but I can't see Kenny. Yeah. Okay. Yes. Sorry.
So I can't hear Mabel right now. Denisha,
Oh, you
Denisha,
can't hear me.
can you hear me okay?
Yes.
I can hear you, Jason.
Okay. I'll tackle some of these other questions here quickly. Do you advise clients not to take on additional debts or loans after they are approved? Once we issue the firm approval, they are absolutely free to take on additional debts and loans, again, as they see fit, right? That really is a customer's decision. We will not pull their credit bureau after a firm approval. The other question, if you can port your existing mortgage but need more funds, is the additional amount considered at a second mortgage rate? The very short answer is yes. And you can do a port increase, and the interest rate on the new funds will be based on whatever time frame is remaining on the existing mortgage term. So if you're 2 years into a 5-year fixed rate mortgage, you want to port, you want to borrow new funds, your new interest rate will be at whatever the 3-year fixed rate is at that time. We'll blend the two rates together. What is the current amortization length? So our maximum amortization is 30 years. Do I think they'll increase to 40? I don't think so. And the reason why I say that is the existing government seems to be quite set on trying to reduce Canadians' overall indebtedness, and also maybe reduce try that again. And also reduce. Sorry, guys, we're getting a bit of
Echo.
How's that?
Okay, I'm gonna leave this meeting because for some reason my computer is beeping and it's making a lot of echo.
All right. So again, just that question about 40 RAMs. I don't think it's coming. I think that what that might do is it might actually spur on another demand in housing. Cash flows will obviously improve if you've got a 40-year amortization, and the government believes that housing prices will go up. I just don't think that there's an appetite for that at the current government level. Medical professionals include chiropractors, naturopaths, and physiotherapists. So no, it really is just restricted under that healthcare program that Mabel mentioned to doctors and dentists. But that group of individuals are self-employed, and we might be able to help them under our self-employed equity program. What about city leases, privately held leases, and fractional interest? That's a great question. I do know that we are able to lend on some provincially and federally leased land, such as UBC and SFU. I know Cultus Lake also is on Parks land, and we've been able to do mortgages up there. Team, anything around privately held leases and fractional interests?
Fractional we don't do. Private leases we also do not do, just because we don't know what Mr. Landowner is going to decide in a few years what he wants to do with it. We prefer to stick with the more, I guess, crown stuff, native leases that are available out there, indigenous leases. But when it comes to private, we actually don't anymore.
All right. Mortgage leaseholds and co-ops, would we consider that? Mabel, Kenny? No.
No.
How is a mortgage helper taken into account from an approval and from a purchasing power standpoint? So mortgage helper I would assume, be a suite in the house. And what we'll do is we will either consider the existing income that suite is earning, or if we had to do a market rent analysis, we'll get that from the appraiser. They'll tell us an estimate as to what the income could be that would be generated from that. And that absolutely will go towards improving your overall debt servicing. Leasehold properties, please distinguish between non-prepaid and prepaid. The non-prepaid leases seem to be left out of the service. Interesting. I just haven't seen that come up, but any thoughts about that?
No. The reason is because I don't know the reasons why the non-prepaid is left out, but I haven't came across a non-prepaid in the years I've been doing this.
So you know what I'll maybe ask is if that, because I don't think we're going to be able to give you an answer on that. And again, just based on our own experience, we haven't come across it. But I would encourage maybe to reach out to Mabel or Kenny, and we'll see if we can't look into that for you. What site for the economics info and the podcast? I'll see if I can send that out to Denisha at RBGV and distribute that to all of you. But I do know this is being recorded, and it is on, I think, our third or fourth slide, and we've got both the URL as well as the name of the podcast on there as well. So we'll make sure that gets into your hands. And another question here: when to pay the down payment on a firm approval, at completion or at the time of the firm approval? Mabel, Kenny?
At completion. The down payment will go towards your lawyer, and your lawyer will collect the funds, get the mortgage from RBC, and then pay the seller's lawyer for you to complete the purchase.
We just want to make sure you have it.
Yeah.
When we do it.
And with regards to the pre-sale firm approval, it's based on the contract, how it's written, when the clients have to come up with the deposit to the developer.
Yeah. And the last question: do you handle commercial mortgages? We sure do. Now, when I say we don't. We're just in RBC's residential mortgage business, but we work quite closely with commercial banking, and also the commercial banking group that specifically lends on commercial properties. So strip malls, warehouses, industrial, we do it all. And again, if whether you're just researching on your own, or if you want to reach out to Mabel or Kenny, we can put you in touch with somebody who'd be able to give you a bit more information on that. All right. Well, listen, just a quick, we did get through all the questions, and I apologize if we moved through them quickly. And that beeping sound, we just still going to try and figure out what that was and track that down. Hopefully it didn't take away too much from our Q&A period. But I just want to, again, thanks everyone for joining us today. Really appreciate it. Before you leave, we do want to remind you of upcoming golf tournament on the 24th of August at Mayfair Lakes. Please get your tickets. We also would love to hear your feedback from today's session. So when you log off, you're going to get a little pop-up link with a link to an event survey. And I know that RBGV would love your feedback. We would too. So please do fill it out. And again, just have a great rest of the day. Take care. And Kenny here as well.
Thank you, everyone.
Thank you.
Thank you.